So guys, in this video I'm going to show you some position management and money management tips. So the tip number one will be a position management tip concerning securing your position. So if you look, for example, in here, then there was the volume accumulation setup, there was a rotation followed by a strong selling activity, the price went back and we went short from there. Now, what happened was that the price went downwards and at some place you want to secure your position. So if the price returns, you don't take, for example, a full stop loss. So what I do with my intraday trades is when the price reaches 75% of my take profit, then I secure my position. So for example, if my take profit is 10 pips, then I secure the position when the price makes 7.5 pips. Alright, and the place where I secure the position is at the reaction point. Now this is the thing I wanted to show you. This is the tip number one, securing the position at the reaction point. Now, as I said, we entered our short level in here. This is the entry point. A lot of people secure their positions on this place, on the break even, but I don't really like this approach because what happens quite often is that the price retests the break even place, retests heavy volumes. This is quite a usual thing that the price returns back there. Alright, so the place where I secure the position is the reaction point. And the reaction point is where the price actually turned. So it is in here. This is the reaction point. This is the turning point where the price turned and the sell-off started. So when the price reaches 75% of my take profit, then I secure the position by moving stop loss to this reaction point. So in this case, you can see that the price went to the level, we went short from there, the price went a little bit upwards, then reversed at the reaction point and went downward into the selling activity. But what happened next is the price returned back to this heavy volume zone, to the entry point. And if we had our stop loss in here, we would be out of the trade. But we have the stop loss at the reaction point, price goes higher, but not above the reaction point. The price actually shouldn't go past the reaction point. If it does, then it's best to quit the trade, alright? The trade is over if it does. But in this case it didn't, and very nice selling activity started. In my experience, securing your position at reaction point is much better than at break even. I've been trading like this for many years and it has always proved much better than securing at break even. Now the tip number two deals with quitting a bad trade when the price doesn't really react to your trading level. So imagine, for example, in this case, that you had a long level in here, alright? This is your long level. There was a strong selling activity and the price went past your level. And if there was a fast rejection of the lower level and the price went upwards again, then it would be fine. It would be fine to hold the trade. But if you see a rotation below your long level, rotation like this one, then this is a sign that the market has accepted the lower prices, that the fair value is temporarily in here. And there is not really any strength pushing the price upwards. There's not really any aggressive activity pushing the price upwards. No aggressive buyers apparent in here. So when you see a rotation below your long level, it's best to quit your trade. Now the best way to quit your trade is, of course, at break even. So if you have a chance, if the price, for example, makes it to the break even, like if the high of the rotation makes it to the break even, then it would be best to quit your trade at break even. Now the rotation below the level is, for example, when you have 2 or 3 30-minute candles below the level, then you know that the level didn't really work, especially if there isn't aggressive rejection somewhere in here. Then you know that there is a new value accepted by the market participants in here, so it's best to quit the trade. Alright, the best is to quit the trade at break even, but if you don't get the chance, you can also quit it, for example, at the high of this price channel, at this rotation. Alright, somewhere in here. Now you always don't need to use this tip, you can trade without it, but if you like to manage your trades actively, then I really think that this could prove useful. And when there is a rotation below your long level, or if there is a rotation above a short level, which would look like this, rotation above short level, then it's just best to try and quit your trade somewhere around the break even. Now, if there was something, for example, like this, price goes upwards, this is your level, this is your short level, and then there was a sharp rejection of higher prices and rotation above the level, then I would still hold the trade because of this, because of the sharp rejection. Alright, this is a sign of strong sellers. So if there is a scenario like this, I would hold the trade. But if there was a scenario like this, I would quit the trade. Alright? Now the tip number 3 is about trading against strong price spikes. Strong spike is something like this. This is a strong spike movement, or there is also one more right there. Those are strong spikes, alright? Price moves very quickly in one direction, and this can be a reaction to macro news, or it could also be a reaction to something that you didn't really know about, something you didn't spot, something you did not notice, and it is best not to trade against such spike moves. So, for example, imagine you had a short level in here, and suddenly the price starts to move aggressively in one directional movement. There's no macro news, but it just happened that the price aggressively goes upwards. You see this development, and in this case, it's just better not to take the trade against the spike move, because a spike move like that is a sign of aggressive buyers or aggressive sellers pushing the price upwards or downwards, and you don't really want to trade against it. Alright, so if you want to actively manage your positions, if you see something like this, then it's better not to take the trade, but instead what you can do is wait until the price returns back to the level and enter a reversal trade, but don't trade against the spike move. Alright, only in a direction of the spike move. So in this case, imagine you had a short level, for example, in here. This is the level. The price was moving aggressively against your level. You didn't enter a short, but you waited until the price returned back to the level, and you enter a long. You enter in the direction of the aggressive movement. Alright? In the direction of the spike move. Now you don't really need to take the reversal trade, but I would definitely recommend being careful about trading against the spike moves. If you're an aggressive trader, you can, for example, trade it with a smaller position, for example, with half positions, but I definitely think that it's very risky to trade against spike moves with full trading positions. Now, what I usually do when there's a spike move like that, I open up a Forex Factory and I look for some unexpected news which just came up. If I see some strong news which came up, and caused the movement, then I don't take the trade, alright? This is a no-brainer for me, but if there is no news and the price is moving aggressively, then I usually tend to take the trade, but with a smaller position. Now, a lot of you probably want to know some definition of a spike move. I would say that spike move is a movement which takes around 20% of daily volatility in around 5 minutes or less. So, for example, if average daily volatility is 100 pips, then if the market makes 20 pips in less than 5 minutes, then it is a spike move. Alright? Now, I would say that 20% is maybe a bit much. Maybe it would be around 15 to 20% actually. 20% would be a really huge spike move. Alright, so that's about the spike moves. That was the tip number 3, and let's now have a look at tip number 4, which deals with quitting trades before macro news. Now, you definitely don't want to trade during macro news. Now I'm talking about intraday trades, alright? Swing trades are a bit different, but when there is a strong macro news, like a red marked macro news, then you definitely don't want to trade it. Now, when I'm talking about red marked macro news, I talk about macro news which are marked in red color on the Forex Factory side. So let me open up the site. Probably most of you know it, forexfactory.com, and in here you can see the red macro news. Those are red macro news, alright? And when there is red macro news like that, you definitely don't want to trade the pair that will be affected by this macro news. You can see in here that it says the currency which will be affected by this macro news. So, for example, today there is a FOMC statement. This is one of the strongest macro news there is. I call this sort of macro news a monster macro news. And you absolutely don't want to trade before this news, during this news, and after this kind of news. Alright, so you definitely want to quit your trade before this news event, like few minutes before it. Because what happens during the news is that the spread widens, and with some brokers the spread could be just huge. You can get slipped and you can just get a great loss, alright? So it's always best to quit your trade before the news. Now let me show you some more examples of the red news. For example, in here, those are red news. Those are news concerning New Zealand dollar. In here, Australian dollar. There is news concerning Japanese yen, Swiss franc, the British pound. All those news are very strong news concerning those currencies. And you definitely don't want to be in a trade, in intraday trade I mean, during such a news. Now, of course, there are some stronger red news and some weaker red news, but the rule of thumb here is just don't trade during any red news, alright? Sometimes red news is really weak, there is not any reaction to it. So when there's a situation like that, you can re-enter your trade, alright? So imagine, for example, you are long from this area, you entered, for example, in here. Now, there is the macro news, it comes up in here. This is the macro news candle. You quit your trade before the news, like for example 5 minutes before the news, and then nothing really happens. There is no volatility, nothing unexpected happened, so you can again jump in the trade. You can continue your trade. But you don't enter for a worse price than you originally entered. So if you entered at this price level, if you entered a long level at this price level, you went long from there, alright? You can only re-enter the trade for a better price or for the same price. So you can enter only in this area, not for a worse price, not in here, not above the long level. Alright, only for the better price, which is below the level. This is where you can re-enter your trade and continue like no macro happened at all. Of course, if the stop loss or profit target would get hit during the macro news, the level is already spent, alright? Only if there is no volatility during the news, you can re-enter after it. Now the last tip, the tip number 5, concerns money management. It's a pretty simple tip, but a lot of people don't get it. The tip is that for every trade, for every intraday trade you take, you need to risk the same amount of money. You know, a lot of people try to predict which level is stronger and which level is weaker, and if they like some level very much, they risk more money. If they don't like a level, they risk less money. But in my experience, you can't really tell in advance which level is stronger and which is weaker, which will most likely work and which won't. Sometimes just the best levels fail and the worst levels work very nicely. So for this reason, I risk the same amount of money on every trade. There are many tools for risk calculation. You just go to Google and if you type position size calculator, you'll see many results. So let's go, for example, to this one. And it's very easy to use. There's the account currency. So if you have your account in dollars, then you use USD. Your balance. So if you have an account with 10 grand, then you type 10 grand. Let's say that you want to risk 2% per trade, and your stop loss is 10 pips. Now you select the currency pair which you trade with, you go calculate. Now you see that you're risking $200 and you should trade 2 standard lots. Alright? Super easy. A lot of people don't use it, but I definitely think this is an essential thing to use. Now some platforms already has this built in. For example, I trade with the CTrader platform, and this platform has already this calculator built in, so I actually don't need to use this calculator. But I know that a lot of you people are trading with the old MT4 platform, and I don't think that this one has it. Maybe there's some plugin for that, but the standard version of the MT4 doesn't have calculators, so you can use, for example, this one. Alright, so that's about it. That's for the money management and position management tips. I hope you found the video useful, and I'll see you in the next one.